It's the 21st of November 2025, and you're listening to BD Daily Finance News Podcast, where we bring you daily insights on technology, markets, and innovation.
U.S. markets just wrapped a volatile week with a strong rebound. The Dow closing roughly 500 points higher after a steep tech-led sell-off earlier in the week.
We'll hit the big stories. The Fed's dovish tilt, an 8% NASDAQ 100 slide, led by Nvidia's $400 billion reversal, crypto's double-digit drop, oil oversupply, Japan's bond and yen pressures, and Eli Lilly joining the $1 trillion club.
We'll also separate durable AI leaders from speculative names, look at Robinhood's 12% weekly decline, and explain how leveraged Bitcoin products and new ETFs are magnifying crypto volatility.
Stick around to the end for a concise playbook on what to watch into next week's data, central bank speeches, and sector rotations, and remember to follow and rate the show if you want this in your feed every weekday. Let's start with the macro backdrop. After a rough stretch for equities, we saw a big bounce today, with one Fed official arguably saving the week for risk assets.
New York Fed President John Williams sounded more dovish, and markets quickly repriced the odds of a December 2025 rate cut back up to roughly 70% to 73%, according to futures data cited in several market outlook pieces.
That shift matters because earlier in the week, hawkish repricing had pushed yields higher, contributed to a more than 2% weekly drop in major U.S. indices, and sparked talk that the Fed might stay on hold for longer.
Exactly, and JP Morgan Asset Management's Mira Pandit echoed that view, saying the Fed may hold rates in December and then cut gradually next year, likely no more than 2 to 3 times, while warning that the recent uptick in unemployment is concerning.
So you have unemployment ticking up, Fed officials talking about cuts, and at the same time policy headlines, tax, tariffs, and monetary policy still driving volatility, with one NBER paper estimating about 30% of market volatility articles tie back to tax policy and another 30% to monetary policy.
Which means for investors, the macro narrative is still in the driver's seat. A one-day 500-point Dow rebound doesn't erase the fact that the weekly close is critical, and one technical note this week warned that if U.S. indices breach their October lows, it confirms a breakdown rather than just a frustrating range.
Before we pivot to tech, give listeners one simple takeaway from this Fed-driven bounce they can act on next week.
Watch the December cut odds and the 10-year yield. If cuts stay priced above roughly 70% and yields drift lower, quality growth and rate-sensitive sectors can catch a bid, but if those odds slide back toward 50%, expect renewed pressure on high valuation names.
Let's talk about the epic tech reversal, because that's where a lot of the pain showed up this week.
The NASDAQ 100 suffered about an 8% sell-off that damaged its medium-term uptrend, and one analysis highlighted that Nvidia's post-earnings rally completely collapsed, erasing nearly $400 billion in market value and triggering broad tech-led selling.
At the same time, Reuters tech coverage noted that U.S. regulators are weighing whether to let Nvidia sell its H200 chips to China, while Google, Amazon, Meta, Microsoft, and even OpenAI are pushing ahead with custom AI chips. So Nvidia is facing both policy risk and intensifying competition.
Right, and some strategists are now explicitly separating what they call the real AI stocks from speculative plays, arguing that while valuations in the frothiest names look stretched, the best-of-breed companies with durable cash flows still justify premium multiples even after this correction.
We also saw AI-linked retail favorites take a hit. Robinhood shares dropped about 12% this week as losses in Bitcoin and AI stocks undercut trading activity in the speculative corners of the market that drive its core business.
That's a reminder that platforms like Robinhood are essentially leveraged to sentiment in high beta themes. When AI darlings and crypto both sell off more than 10% in a short window, you tend to see lower volumes, fewer options trades, and pressure on transaction-based revenue.
For listeners holding big AI winners, what's a practical risk check to run this weekend?
Look at revenue growth versus valuation. If your AI name is growing under 20% but trading at 20 to 30 times sales, that's speculative. If it's compounding revenue 30% to 40% with strong free cash flow, you can justify staying through volatility, maybe trimming rather than exiting.
Sticking with big tech, the technical picture on the NASDAQ 100 has clearly deteriorated.
The 8% drawdown from recent highs, combined with weakening market breadth, has some analysts calling for a multi-week corrective decline, arguing that if the index closes the week below key moving averages, it opens the door to retesting the October lows.
One weekly outlook note framed it as a fork in the road. A decisive breach of those October levels would confirm a more durable breakdown, while a rebound from here would simply extend the range-bound, frustrating action we've seen since the spring.
Technically, that argues for patience. Instead of trying to pick the exact bottom, many systematic strategies wait for breadth to improve, say, more than 60% of components back above their 50-day moving averages before increasing exposure again.
So if you're a long-term investor, the message is to avoid overreacting to a single ugly week. But if you're tactical, the weekly close around those October reference points really matters for your positioning.
Exactly, and we'll know within a few sessions whether this rebound is the start of a new leg higher or just a classic bear market style bounce within a larger consolidation.
Let's zoom out globally, because developments in Japan this week could have big implications for U.S. bonds over the next year.
Japanese markets have had a turbulent stretch, with Prime Minister Sanae Takaichi's large spending plans pressuring both the yen and government bonds, and roughly $127 billion wiped off the value of Tokyo-listed stocks over the past week.
A separate analysis warned that trouble for Japan, the biggest foreign buyer of U.S. debt, could ripple through America's bond market, because if Japanese investors keep more savings at home to absorb rising local yields, they might reduce demand for treasuries.
That's key. Japanese institutions hold hundreds of billions in U.S. government bonds, so even a modest portfolio shift could nudge U.S. yields higher at the margin, tightening financial conditions, even if the Fed is cutting rates at the short end.
For bond investors listening, that means you can't just watch the Fed. You also need to monitor foreign demand, especially from Japan, because that's a hidden driver of the 10-year and 30-year parts of the curve.
And in practical terms, it argues for some duration diversification, mixing U.S. treasuries with other high-quality sovereigns, or even investment-grade corporates, rather than betting everything on one part of the U.S. curve.
Let's jump to commodities, because the oil market is quietly flashing some important signals.
A detailed oil outlook flagged a growing oversupply problem, with oil on water, volumes crude sitting on tankers surging as producers struggle to place barrels in final markets, and a significant share of that buildup coming from sanctioned Russian supplies.
New sanctions taking effect around the 21st of November 2025 are expected to further increase floating volumes, deepening the surplus and putting downward pressure on spot prices and time spreads.
For investors, that typically weighs on upstream producers and can flatten or even invert parts of the futures curve, while benefiting refiners and transport names that profit from cheap feedstock and higher volumes.
So if you're overweight pure-play E&Ps that need $80 plus crude to justify CapEx, this is a good time to stress test your thesis against a scenario where oversupply keeps a lid on prices into next year.
And if you're more tactical, you might look at relative trades, long refiners, short high-cost producers to express a view on this emerging surplus without taking outright price risk.
Staying with commodities, silver has also been in focus as volatility picks up.
One note described it as a time of higher silver volatility, with investors betting on a December 2025 Fed rate cut, and dovish signals plus bond moves and mixed inflation data fueling uncertainty about real yields, which are a key driver for precious metals.
Because silver trades both as a monetary metal and an industrial input, it tends to move more sharply than gold when markets swing between inflation and growth scares, which is exactly what we've seen over the past few sessions.
If you're using silver as a hedge, size it modestly, often 2% to 5% of a diversified portfolio, because the same volatility that helps in a crisis can hurt if you oversize the position and the Fed path doesn't play out as expected.
Let's turn to crypto, where the red ink has been even more dramatic than in tech.
Crypto markets plunged toward their April lows on Friday, with Bitcoin and Ether both falling more than 10% in a short span as a lingering liquidity crunch amplified price swings, according to CoinDesk's market wrap.
Altcoins were hit even harder. We saw headlines about HBAR crashing more than 11.5%, ICP breaking major support with a volume spike, confirming an accelerated downtrend, and an analyst warning that Bitmine Immersion is sitting on a roughly $4 billion loss on an Ether bet amid structural issues.
Ethereum itself is holding up relatively better, but is fast approaching a critical technical zone around $2,700, and one multi-time frame analysis asked bluntly whether this is the start of a new crypto bear market or just another leverage-driven shakeout.
We also saw reports that Japanese Bitcoin treasury firms continue to outperform U.S. peers, in part because local tax policy makes it easier for them to hold BTC on balance sheet and ride out these drawdowns.
That highlights how regulation and tax treatment can change the risk profile. A U.S. House bill is even being floated that would allow federal taxes to be paid in Bitcoin while supporting U.S. reserves, which, if it gained traction, would be a major step toward mainstream adoption.
For listeners who saw their portfolios drop double digits this week, what's the key risk check? Especially if, like one personal finance story we saw, their retirement is completely in Bitcoin and they're borrowing against it.
If more than 20% of your net worth is in a single volatile asset like Bitcoin, and you're also using it as collateral, you're exposed to margin calls and forced selling. A more sustainable approach is to cap crypto at a smaller share, often under 10%, and avoid leverage entirely.
Adding to the complexity, there's a wave of new crypto products hitting the market even as prices slide.
In Europe, the first ever 3x levered Bitcoin funds are launching next week. And one analysis bluntly said the timing couldn't be worse because leveraged ETFs bring even more risk to an already volatile asset class.
In the US, Grayscale is rolling out Doge and XRP ETFs on the NYSE, and Coinbase is reportedly set to acquire a Solana-based DEX called Vector as its acquisition spree continues, signaling that institutional infrastructure is still being built despite the drawdown.
The key is that these products lower the friction for both sophisticated and retail investors, but they don't change the underlying volatility. If anything, leveraged products can force intraday rebalancing that exacerbates moves when markets are already stressed.
So if you're tempted by a 3x Bitcoin ETF after a 10% drop, remember that a further 10% move down in the underlying could translate into roughly 30% losses for you, and compounding effects can make it even worse over time.
For most investors, plain, unlevered exposure, if any at all, is the right starting point, and position size should reflect the possibility of 50% drawdowns without derailing your broader financial plan.
Let's pivot to currencies, starting with the euro-dollar pair, which has been quietly coiling in a tight range.
Euro-USD is contracting into what one strategist called a 2,000 pip consolidation band between roughly 1.15 and 1.17, with recent dollar demand from hawkish Fed repricing being offset by those dovish comments from Williams that put the December cut probability back near 70%.
On the euro side, business activity remains solid in November, driven by services, but new orders are slowing and costs are rising, while Q3 negotiated wages disappointed at around 1.87% year-on-year, raising questions about how much domestic inflation pressure the ECB is actually facing.
Technically, Euro-USD is eyeing a lower low, but that's contingent on the US dollar index not forming a double top. Traders are watching ECB President Lagarde's speeches for any hint that the bank wants a stronger euro to reinforce its role on the world stage.
For most equity-focused listeners, the practical takeaway is that a stable euro-dollar range helps keep imported inflation and earnings translation effects relatively predictable for multinationals.
Exactly. And unless we break decisively out of that 1.15 to 1.17 zone, currency swings are more of a background factor than a primary driver for risk assets.
On the credit and real estate front, there was an interesting bright spot out of Chicago.
Bank of America Tower in Chicago is being refinanced with about $700 million in bonds. Reportedly the city's biggest mortgage bond deal since COVID, which stands out against an otherwise beaten-down commercial real estate backdrop.
That suggests investors are still willing to fund high-quality, well-leased properties in prime locations, even as they remain cautious on older, lower-occupancy buildings.
For bond investors, it's a reminder that not all office exposure is equal. Deal structure, tenant mix, and city fundamentals matter far more than the headline sector label.
Staying with credit, we also saw a notable shift in how one defense contractor is financing itself.
Carlyle-backed Mantech International scrapped a planned $2.3 billion leveraged loan sale amid weak demand and instead opted to raise funds from private credit lenders, according to people familiar with the matter.
That's another data point in the ongoing shift from syndicated loans toward private credit, where direct lenders can move faster and structure bespoke deals, but often at higher spreads and with less transparency for public investors.
For portfolios, it means that if you're only looking at the leveraged loan market, you may be missing a growing slice of corporate borrowing and risk that's migrating into private vehicles and business development companies.
Let's circle back to AI infrastructure and the policy angle, because that's another big theme for the 21st of November 2025.
Reuters reported that U.S. officials are mulling whether to let NVIDIA sell its H200 AI chips to China, a decision that will shape both NVIDIA's revenue mix and China's access to cutting-edge compute, at a time when hyperscalers like Google, Amazon, Meta, Microsoft, and OpenAI are designing their own custom ASICs.
That custom silicon trend means that even as Nvidia's sales are still described as off the charts, the long-term bargaining power may gradually shift toward large buyers who can dual source or in-house more of their NSE compute needs.
It also intersects with resource security. One analysis warned that China controls key rare earth elements that AI infrastructure needs. And because the US relies on AI to grow GDP, any disruption to that supply chain could hit both tech earnings and the broader economy.
So investors in AI hardware need to think not just about demand growth, but also about export controls, supply chain concentration, and the possibility of reshoring or diversification drives in critical minerals.
And that's where some see opportunity in mining, recycling, and alternative materials companies that can help reduce that dependency over the next decade.
Switching gears to healthcare. Eli Lilly just hit a historic milestone.
Lilly became the first pharma group ever to join the $1 trillion market cap club, with shares up almost 40% this year on the back of strong demand for its GLP-1 weight loss and diabetes drugs, making it the poster child of the GLP-1 is the new AI narrative.
One headline even framed it explicitly as, "Is GLP-1 the new AI?" arguing that these drugs could reshape everything from healthcare spending to food, beverage, and fitness industries if uptake remains strong.
For investors, that means thinking beyond just Lilly and Novo Nordisk to second-order effects, reduced demand for certain high-calorie foods, potential shifts in cardiovascular and orthopedic procedures, and even changes in insurance and employer wellness programs.
But with a $1 trillion valuation, expectations are sky high, so any safety signal, pricing pressure, or competitive surprise could trigger sharp corrections, similar to what we just saw in AI leaders.
That's why position sizing and diversification matter. Even in world-changing themes, concentration risk can hurt when sentiment swings.
Let's briefly touch on climate policy, because it ties back into energy and long-term capital allocation.
At the UN Climate Summit, COP30 talks have reportedly gone into overtime, deadlocked on fossil fuels and finance, with the EU and allies clashing with oil producers, led by Saudi Arabia and Russia over the language and pace of any phase down.
That uncertainty keeps both traditional energy and renewables in a policy tug-of-war, complicating long-dated investment decisions for utilities, oil majors, and infrastructure funds.
For investors, it argues for a barbell approach, owning both efficient, low-cost fossil fuel producers and high-quality renewables, rather than trying to perfectly time a one-way transition.
Zooming in from global policy to your wallet, holiday shopping season is here, and many Americans will lean heavily on credit cards.
A MarketWatch personal finance piece laid out 6 key tips to preserve your credit score and sanity, emphasizing basics like keeping utilization under 30%, paying more than the minimum, and avoiding store cards with very high APRs.
They also warned about the risk of slipping into a debt spiral, especially if you're tempted to carry balances at rates north of 20%. Which can quickly turn a few $100s of gifts into thousands of dollars of long-term interest.
A simple rule of thumb is to set a hard holiday budget, track it weekly, and commit to paying off any seasonal balance within 3 months, so you're not still paying for this year's gifts next summer.
Speaking of the consumer, let's quickly preview the retail-heavy earnings slate highlighted in one of the week-ahead segments.
CNBC's Jim Cramer ran through upcoming reports from Burlington, Best Buy, Kohl's, and Dell, noting that these names will give us a clearer read on discretionary spending, electronics demand, and how much pressure tariffs and higher rates are putting on middle-income shoppers.
Given that U.S. stocks struggled this week despite strong numbers from Walmart and Nvidia, the bar is high. Any sign of weakening traffic or heavier discounting could reinforce the narrative that the labor market is topping and tariffs are biting the consumer.
So if you own retail, watch not just EPS but also inventory levels, markdown rates, and commentary on buy now, pay later usage, which can be an early warning sign of consumer stress.
Back to crypto for a moment. There was also a notable regulatory development from the banking side.
The U.S. Office of the Comptroller of the Currency issued guidance confirming that banks have authority to hold certain crypto assets as principal for specific purposes, according to a November 18, 2025 news release labeled 2025-108.
That doesn't mean every bank will suddenly pile into Bitcoin, but it does clarify the regulatory perimeter and opens the door for more structured, on-balance sheet crypto activities under strict risk controls.
Combined with the ETF launches we discussed earlier, it's another sign that, despite price volatility, crypto is being slowly integrated into the traditional financial system's plumbing.
On the intersection of sports, betting, and crypto, there was a partnership announcement worth noting.
Fanatics is entering prediction markets via a partnership with Crypto.com, which could blend sports fandom, on-chain infrastructure, and regulated wagering into a new product category.
That's part of a broader trend of tokenized prediction and betting platforms, which regulators are watching closely because they blur the lines between gaming, derivatives, and securities.
For investors, the key is to differentiate between picks and shovels, plays, exchanges, infrastructure, and data providers and pure speculation tokens tied to individual platforms.
Let's touch on geopolitics and capital flows, particularly Saudi Arabia's evolving relationship with the U.S. and tech.
After high-profile meetings between U.S. leaders and Crown Prince Mohammed bin Salman, analysts expect the kingdom's strategic shift from petrochemicals to technology to materialize in the form of sizable investments into U.S. and global tech, according to one Bloomberg segment.
That could mean more capital funneled into AI, cloud, and semiconductor projects, potentially supporting valuations even as public markets wobble.
But it also raises questions about governance, national security reviews, and the long-term alignment of these investments with U.S. policy goals.
On the alternative asset side, Bill Ackman is reportedly preparing a major move.
The Financial Times reported that Ackman is revving up plans for an IPO of Pershing Square Capital Management, potentially as early as the first quarter of 2026, turning his hedge fund into a publicly traded entity.
That would give retail investors more direct exposure to his strategy, beyond the existing Pershing Square Holdings vehicle, and reflects a broader trend of alternative managers tapping public markets for permanent capital.
But as always, performance fees, governance structure, and alignment of interests will be critical details to scrutinize if and when a prospectus drops.
We won't wade into politics in detail, but it's worth noting that headline risk remains elevated, from U.S. domestic disputes to Ukraine peace proposals and shifting alliances.
Those political developments often show up indirectly in markets via tariffs, sanctions, and defense spending, so investors should watch policy outcomes rather than the daily drama.
Let's look ahead to next week's macro calendar, because positioning into that is critical.
A Markets Weekly outlook flagged the UK budget as a major event, with global equities eyeing recovery after a volatile week, while the US dollar had a strong run and intervention fears grew around the Japanese yen.
The same note highlighted a relatively quiet U.S. Thanksgiving week, but key data out of China and Japan, plus ongoing technical focus on the U.S. dollar index, or DXY, which has been flirting with important resistance levels.
For equity investors, that means currency and bond volatility could be the stealth drivers of returns, especially for internationally exposed sectors.
We've mentioned the AI bubble debate a few times. Let's tackle it head-on.
A recent podcast recap noted that despite strong earnings from Walmart and Nvidia, U.S. stocks endured a rough week, with sentiment hurt by fears of peaking AI investment, a topping labor market, and tariffs hitting consumers, even as Fed commentary swung the December rate cut probability back to about 73%.
Some strategists argue that while pockets of AI are bubbly, the core enablers, cloud, semis, and select software still have earnings power to back current prices, especially if you look out 3 to 5 years rather than 3 to 5 months.
The key is to avoid chasing revenue-less stories and focus on companies with clear monetization paths, recurring revenue, and strong balance sheets that can invest through the cycle.
We should also mention flows, because they tell you where conviction is or isn't.
A Bloomberg TV segment noted that Bitcoin ETFs have seen major outflows this week as prices slid, underscoring how quickly sentiment can turn when investors treat these vehicles as trading instruments rather than long-term holdings.
That flow volatility can feed back into prices, especially when combined with futures positioning and the leveraged products we discussed earlier.
For long-term holders, the best response is often to ignore short-term ETF flows and focus on your own allocation rules and time horizon.
Behind all these numbers are real people, and a couple of personal finance stories this week drove that home.
We saw one family grappling with a father planning to leave their money to a church against their dying mother's wishes, and another dealing with a landlord disposing of a late uncle's art collection, both reminders that estate planning and documentation matter as much as market returns.
Those situations underscore why clear wills, beneficiary designations, and conversations with loved ones are essential parts of financial planning, not afterthoughts.
If you've been putting off that paperwork, consider this your nudge to start, even if it's just a basic will and updated account beneficiaries.
We're about halfway through, so let's quickly recap before we hit a few more angles.
So far, we've covered the Fed-driven rebound with December cut odds back near 70%, an 8% NASDAQ 100 slide led by a $400 billion Nvidia reversal, crypto's more than 10% drop toward April lows, oil oversupply and floating storage, Japan's bond and yen pressures, and Eli Lilly's $1 trillion GLP-1 milestone.
If you're finding this breakdown useful, take a second to follow the show, tap 5 stars in your podcast app, and share this episode with a friend who's trying to make sense of 2025's markets.
And if there's a ticker, sector, or theme you want us to cover, drop it in the comments or send us a note. We build future episodes around your questions.
Back to tech. There was a striking story about robotics and safety that could have broader implications for AI hardware companies.
A former engineer at Figure AI filed a lawsuit claiming he was unlawfully terminated after warning executives that the startup's robots could, in a worst-case scenario, fracture a human skull, raising questions about internal risk controls and whistleblower protections.
While that's one company and one lawsuit, it highlights the importance of safety, engineering, and governance as humanoid robots move closer to commercial deployment.
For investors, it's a reminder to look beyond glossy demos and ask how companies are managing physical, legal, and reputational risks around AI-driven machines.
Let's also acknowledge how retail investors are consuming all this information. Because platforms matter.
Sites like Yahoo Finance, MarketWatch, and CNN's market data pages are providing free quotes, international data, and personal finance advice, while social platforms and communities like Cryptocurrency amplify news, sometimes adding insight and sometimes adding noise.
The challenge is filtering. Not every hot take on a message board is research, and not every headline warrants a trade.
That's why having a written plan what you own, why you own it, and when you'll sell can help you stay grounded when your feed is flashing red.
We mentioned earlier that sentiment is being hit by concerns about a topping labor market and tariffs biting the consumer. Let's unpack that briefly.
An uptick in unemployment, even from very low levels, combined with higher tariffs on imported goods, effectively squeezes disposable income from both sides, fewer hours or jobs on one hand, higher prices on the other.
That's why we're watching not just headline retail sales, but also credit card delinquencies, buy now, pay later usage, and commentary from companies like Walmart and Best Buy about basket sizes and trading down behavior.
If those indicators deteriorate together, it would validate the market's recent worries about consumer resilience heading into 2026.
Stepping back, there's an interesting triangle forming between AI, GLP-1 drugs, and resource security.
AI needs massive compute and rare earth inputs. GLP-1 second are reshaping health and consumption patterns, and both are attracting enormous capital while countries jockey to secure the resources and IP behind them.
Investors who think in systems, how chips, minerals, health, and geopolitics interact may be better positioned than those who only look at single stock stories in isolation.
That's why diversified thematic baskets, rather than concentrated bets, can make sense in these complex, fast-moving areas.
Before we wrap, let's give listeners a quick checklist they can run through this weekend.
First, review your exposure to high-beta tech and crypto. If those positions are driving most of your volatility, consider trimming or rebalancing toward quality and cash flow positive names.
Second, stress test your assumptions on rates and inflation. With December cut odds around 70% but not guaranteed, ask how your portfolio would fare if cuts are delayed or if long yields stay higher because of foreign demand shifts.
Third, check your sector balance. Do you have any single-theme AI, GLP-1, or energy making up more than 20% of your equity exposure? If so, think about whether that concentration still matches your risk tolerance.
And finally, on the personal finance side, look at your holiday spending plan and your estate documents. Markets matter, but so do your credit score and your family's legal protections.
If you tackle even one of those items this weekend, you'll be in a stronger position heading into the final stretch of 2025.
Let's close with a quick recap of the key numbers and narratives from the 21st of November 2025.
U.S. stocks rebounded with the Dow up about 500 points after a rough week. Fed December cut odds climbed back towards 70% to 73%. The NASDAQ 100 is still down roughly 8% from highs after a $400 billion Nvidia reversal. Crypto saw Bitcoin and Ether drop more than 10% toward April lows. Oil faces growing oversupply and rising oil on water volumes. And Eli Lilly became the first pharma to hit a $1 trillion market cap on GLP-1 demand.
We also touched on Japan's $127 billion equity drawdown and bond pressures, new crypto products and OCC guidance, silver volatility, UK budget risk, and the human side of finance, from holiday credit to estate planning.
If you want more of this kind of fast, data-driven rundown, make sure you follow BD Daily Finance News Podcast, leave a rating, and share today's episode with someone who's trying to navigate these markets.
And tell us what you want to hear next: AI stocks to watch, crypto regulation, GLP-1 ripple effects, or something totally different, so we can tailor future shows to your questions.
Thanks for spending part of the 21st of November 2025 with us. Manage your risk, stick to your plan, and we'll be back next episode with more on technology, markets, and innovation.
For BD Daily Finance News Podcast, I'm your host, signing off. See you next time.